Hey there, Brad Castro from GreatOptionTradingStrategies.com, your value investing with options headquarters. In this video, I want to talk about 3 ways you can protect your portfolio and investing capital. And when we talk about protection and risk and all that, what we're really asking is, how do you avoid the greatest risk that faces any trader or investor, the permanent loss of capital? Now, I'm not going to be going over any individual tactics or strategies like married puts or stop-loss orders or anything of that nature. Instead, I want us to take a larger view. I want us to look at the bigger picture and explore how we can become better risk avoiders at a structural level. First, a little background. Benjamin Graham, the father of value investing and one-time mentor to a young Warren Buffett, lost a lot of money in the 1929 stock market crash, as in his clients' money. And that experience changed him. He basically said, never again. And as a result, he came up with a couple of important concepts: intrinsic value and margin of safety. Now, intrinsic value is basically the attempt to determine or estimate on a fundamental basis what an asset is really worth. Now, that asset could be a company's bonds, or it could be the company itself. To give himself what he called a margin of safety, Graham only invested in an asset when it was trading or selling for a significant discount to what he determined its intrinsic value was. Okay, that's the background. Now, let's go ahead and look at the 3 ways you can go about securing your own margin of safety to avoid permanent losses. Margin of safety number 1, price. The first kind of margin of safety is the one Graham himself envisioned, price. Now, others may prefer the word value over price, but we're essentially talking about the same thing. The less you pay for an asset in relation to its true worth, the safer you're going to be. That seems like a no-brainer, right? Well, no one was talking about that idea prior to Graham, and even today, when the concept is widely known, most trading and investing is momentum or directional based, not value based. One other quick but important point about intrinsic value: it's never going to be a precise value. Graham recognized this himself. He understood that at some level there are always subjective elements and assumptions that get baked into the calculations. And that's part of the reason for the margin of safety. It helps protect you from yourself in case some of your subjective assumptions turn out to be wrong. Margin of safety number 2, quality. The second margin of safety available to you is, in my opinion, just as powerful as price, if not more so. And that's the protection you gain from the quality of the investment itself. Quality is a tremendous and often overlooked margin of safety. Okay, this is something of an oversimplification, but if you view Graham's margin of error as risk control based on price and valuation, then it's Warren Buffett's approach that epitomizes the quality principle. Graham exerted a big influence on Buffett, but Buffett's own value investing philosophy eventually made a notable evolutionary leap. Buffett eventually embraced the idea that quality is at least as important as price. When you own a high-quality business, your primary protection is the operations of the underlying business itself. It's true that you don't want to overpay for your investments, but the great luxury of investing in world-class businesses is how great it feels to know that when you wake up each morning, your awesome business will still be there making lots of money for you. Do you really want a good deal on a bad business? Is there really a margin of safety in that approach? Warren Buffett made this very point himself in a talk he had with MBA students back in 1998. And he said, "Time is the friend of the wonderful business. It's the enemy of the lousy business. If you're in a lousy business for a long time, you're going to get a lousy result, even if you buy it cheap. If you're in a wonderful business for a long time, even if you pay a little too much going in, you're going to get a wonderful result if you stay in a long time." Margin of safety number 3. Why not both? Price and quality. Now, if you've spent any time on the Great Option Trading Strategies website, then you know I don't believe in or accept the either-or mindset. I refuse to live in that kind of world. I'm a firm believer in and practitioner of the both-and philosophy. So instead of debating whether choice A is better or whether choice B is better, why not take the best qualities from each choice and combine them to make a new choice, choice C? That's basically what I did when I combined the best attributes of value investing with the best attributes of option trading to design the complete leverage investing program, which you can learn more about in the link below this video. So in this case, when you combine price and quality, you create a new, expanded margin of safety that's exponentially stronger than either price or quality by itself. It's the classic tale of something being greater than the sum of its parts. If you can manage both feats, buying high-quality stocks at discounted prices, you'll have the best of both worlds, superior returns and below-average risk. Now for some, that's a pretty radical concept because of the number that the managed money industry has done on the investing public. You've probably seen something like this graph before. This is a pretty fair representation of what people who manage other people's investments like to circulate. It shows that if you want low risk, you have to accept low returns. And if you want high returns, you have to be willing to tolerate a lot of risk. That's completely bogus, and it's more about justifying the managed money industry's abysmal track record than educating people how investing really works. Why have so many people bought into this nonsense? High risk doesn't mean that you've got a chance to do better than everyone else. It means that it's just a matter of time before you lose everything. I'll give you an extreme hypothetical scenario with two choices to illustrate. Choice number 1. You play 6 rounds of Russian roulette with yourself. If you survive, I pay you $1 million. Choice number 2. I sell you a McDonald's franchise at a busy, low-crime intersection for $1,000. So, which choice has the lowest possible risk and the highest possible returns? The less you pay to own, in whole or in part, a high-quality business, the lower your risk and the higher your returns. That's a cold, hard investing fact. Actually, it's not cold or hard at all. It's warm and liberating. The trick, of course, is how do you go about finding those kind of opportunities? There's the traditional approach. This is what a lot of old-time investors did, and you know what? It works as long as you're patient and disciplined. Basically, you just sit around and wait for the market to occasionally misprice the shares of a great business. And when it does, you plow a bunch of the cash you've been saving into as many shares as you can get. And then you go back to saving and waiting for the next opportunity to show up. Myself, I prefer to use strategic, low-risk option trades to make my own opportunities. No disrespect to traditional investing styles, but I've got better things to do than just wait around hoping Mr. Market will have a tantrum and give me a rare buying opportunity on his own, especially when I don't have to. Now, it's too much to go into all the details of how value investing with options works, but if you want to learn more, I'd urge you to head over to the Great Option Trading Strategies website by using any of the links below and check out the free resources and information I provide. Take care and talk to you later.